And Peter, this is an interesting move here for markets only because we're at record highs. It's not out of the realm of reason for a pullback. But is this something we should be worried about because the data out there may not support the market at current levels?
Well, the catalyst the entire year have been Fed rate cuts and a trade deal, even though we've obviously had some bumps in the road on that trade deal. But now we've gotten the rate cuts, and we seem to be on the cusp of a trade deal of some sort. So in a way, we maybe have exhausted those two catalysts, and in order to sustain this, we need the economic data to respond positively, and we need the earnings slowdown to reverse itself to the upside. But that may not be till 2020.
So the whole market, globally speaking, has been kind of like part of this rising tide. We've been focusing so much on the U.S. because it is the driving force behind what's happening in the markets, globally speaking. But when you see action like in Asia overnight, these are some sharp moves to the downside. Is it kind of calling into question a little bit about what's going to happen if the rest of the world cannot get its act together with regard to markets?
Well, overseas markets have finally caught up in terms of performance. They've been underperforming for many years. And hopes on this deal and the rate cuts certainly have helped, in addition to some recent weakness in the dollar. But in order to sustain that, you need to see details on this trade deal. You need to see, are we going to see tariffs come off? Not just the December ones, but the existing ones. And that remains to be seen here. But the economy is slowing, and we have to deal with that reality. Earnings growth is now reversed to the downside. So that's the fundamental basis. So a lot of the rally has been on hopes that this would reverse itself. But again, the reality is that global growth continues to slow.
You know, every time there's a major piece of economic data, you know, one of the things that you're great about doing is kind of telling your clients, telling those of us, kind of breaking down all the information. You mentioned the economic data is a little bit weaker these days. Earnings growth is now turned negative. With that being said, is this a situation where the markets can continue that way if the Fed does what it does and the markets kind of churn around the way that they do at current highs?
So with respect to the Fed, the 3 cuts we got were considered insurance, mid-cycle adjustments. Any further cuts from here would be crossing a line in terms of them now addressing deeper economic slowdown. On the other hand, there's obviously hopes that this is a soft landing. The 3 is all they need to do, and that will be enough to stimulate growth further. And then on the trade side, well, if there is a deal of some sort, a détente, a calmness, even though we'll have still remaining tariffs, will that be able to inflect higher the slowdown in manufacturing and trade?
So we've had a number of guests on our air over the course of the past couple of weeks. Over the past few months, we've said PMIs, ISMs, a lot of these indicators have shown a deterioration. But now we're hearing folks calling it a bottoming process. Do you believe that it's a bottoming process right now for all those manufacturing and services gauges across the world?
There's a short-term stabilization, but whether that inflects higher will depend on how we respond, again, to those rate cuts and what kind of deal we get. I think if the tariffs still remain on in bulk, it'll be hard to get this inflection point much higher. So that's a 2020 story. It remains to be seen. Let's be hopeful, but I'm not sure, because now that weakness in manufacturing is spilling over into services. And services, at least in the U.S., is the predominant part of the U.S. economy.